Hey everyone, in my last video we talked about stocks, how they're pieces of ownership in companies. But stocks aren't the only ways to invest your money. Today we're diving into something called bonds. You've probably heard people say things like, I have a balanced portfolio of stocks and bonds, or heard news anchors talk about the bond markets. But what actually is a bond? Don't worry, I'm going to break it down using simple examples that make total sense. By the end of this video, you will understand exactly how bonds work and why they're such a big deal. So let's jump in. All right, let's start with a story. Remember Maria from our stock video? The one with the amazing pizza shop? Well, her business is doing great and now she wants to expand. She needs $50,000 to open a second location. This time, instead of selling more ownership in our company, Maria has a different idea. She asks you, hey, can you lend me $10,000? I'll pay you back in 5 years, and I'll pay you $500 every year as interest for lending me the money. You think about it, Maria's business is doing well, you trust she will pay you back, and earning $500 a year sounds pretty good. So you agree and give her the $10,000. Congratulations, you just bought yourself a bond. Well, kind of. In real life, it would be more formal, but that's the basic idea. A bond is essentially an IOU, a loan that you give to a company or government and they promise to pay you back with interest. Instead of owning a piece of the business, like with stocks, you're a lender. Maria owes you money. You have a bond with specific terms. So you have the principal, which is $10,000, the amount you lent. You have the term, which is 5 years, when you get your money back. And then you have the interest, which is 5% or $500 per year. So every year for 5 years, Maria pays you $500. Then at the end of year 5, she gives you the original $10,000 back. You've made $2,500 in interest over those 5 years. So what are the types of bonds? Now, Maria Pizza Shop is just one small example. In the real world, bonds are issued by all kinds of organizations that need to borrow money. We have corporate bonds. These are from companies. Maybe Apple needs to raise $2 billion to build a new factory. Instead of taking a bank loan, they issue bonds. You could buy an Apple bond, lend them $1,000, and they will pay you interest and return your money at maturity. Then you have government bonds. Governments need money for highways, schools, military, and other expenses. The US government issues what we call treasury bonds, also called T bonds. These are considered super safe because they are backed by the full faith of the United States government. States and cities also issue bonds, which we call municipal bonds or munis. The difference between these bonds mainly comes down to risk or the interest rate. Government bonds, especially US Treasury bonds, are considered very safe. The government has never defaulted on them. Not yet. But because they are so safe, they pay low interest rates, maybe 3 to 4%. Then you have corporate bonds, which are riskier. Companies can go bankrupt, so they pay higher interest rate to attract investors, maybe 5 to 8% or even more for riskier companies. It's like this. Would you lend $1,000 to your responsible friend who has a steady job or to your cousin who is always broke? You might lend to both, but you would probably charge your risky cousin a higher interest rate to make it worth the risk. So, in practice, how do bonds work? Let's walk through a real example. Say the US government issues a 10-year treasury bond with a face value of $1,000 and a 4% interest rate. Here is what happens. Year 1 to 10, every year, the government pays you $40, that's 4% of $1,000. This payment is called a coupon payment. It's predictable income, you know exactly what you're getting. Year 10, the bond matures. The government gives you your $1,000 back. Over 10 years, you receive $400 in interest payment plus your original $1,000 back. Not bad for basically lending money, right? Now, here's where it gets interesting. You don't have to hold the bond until maturity. Just like stocks, bonds can be bought and sold in the bond market. Let's say after 2 years you need cash and don't want to wait 8 more years, you can sell your bond to someone else, but here's the catch. The price you sell it for might not be $1,000. Bond prices move opposite to interest rates. This is super important. So if interest rates goes up, bond prices go down. If interest rates go down, bond prices go up. Here's why. Imagine you bought the bond paying 4% interest, but now new bonds are being issued at 6% because rates went up. Your 4% bond suddenly looks less attractive. If you want to sell it, you'd have to sell it for less than $1,000 to make it appealing, maybe $900. That way, the buyer thinks it's a great deal and effectively ends higher return. The opposite happens when interest rate falls. If new bonds only pay 2%, your 4% bond is awesome. You could sell it for more than $1,000 because people want that higher interest rate bond. So let's look at how bonds compare to stocks. Let's break it down. With stocks, you're an owner of the company. You make money if the stock prices goes up from dividends, and you have higher potential returns, historically 10% per year average, but also higher risk. Prices can swing wildly. If the company goes bankrupt, you might lose everything. With bonds, you are a lender to the company or the government. You make money from predictable interest payments. Lower returns, maybe 3 to 6% depending on the bond, and then there's less risk. More stable and predictable. If the company goes bankrupt, bondholders get paid back before stockholders. Think of it this way. Stocks are like riding a roller coaster. Exciting, potentially huge gains, but also scary drops. Bonds are like taking a calm train ride. You won't get there as fast, but it's a smoother, more predictable journey. That's why financial advisors often recommend having both in your portfolio. When you're young with decades until retirement, you might want to have 90% stocks and 10% bonds. As you get older and closer to needing your money, you might shift to 50% stocks and 50% bonds, or even more bonds. The bonds provide stability and steady income. So why do bonds matter? Right? Why should you care about bonds? 1, for steady income. Bonds pay regular interest, which is great if you need predictable cash flow. Retirees love bonds for this reason. Number 2, for preservation of capital. If you know you will need money in 5 years for house down payment, bonds are safer than stocks. You're much more likely to get your money back. Then you have number 3, for portfolio balance. When the stock market crashes, bonds often hold steady or even go up. They act as a cushion in your portfolio. 4, they're everywhere. They're actually a bigger market than the stock market, right? Understanding bonds helps you understand how the economy works. Here is a real world example. During the 2008 financial crisis, the stock market lost about 50% of its value. Many people who were 100% in stocks saw their retirement savings cut in half. But people who had bonds in their portfolio didn't lose nearly as much because their bonds held their value. That's the power of diversification. Alright, let's recap. A bond is a loan you give to a company or government. They pay you regular interest and return your principal at maturity. Bonds are generally safe than stocks, but they offer lower returns. They are perfect for adding stability to your investment portfolio. The bond market is huge and affects everything from mortgage rates to how government fund projects. Now that you understand the basics, let me know if this helped you out. Comment below, are you more interested in stocks or bonds and why? And subscribe for more finance videos that actually make sense. Thank you for watching. I'll catch you in the next session.